Hi everyone and welcome to another Isvista Financial Services video update. This is the second instalment to property investing versus a share investment portfolio. So in the first episode we dealt with the benefits of investing in property versus shares in terms of the returns you might get particularly if you leverage a property. So in this installment, we're talking about the risks that are associated with investing in property using a mortgage versus investing in a share portfolio. So what are the risks? Well, again, we've got property investment up here on the left and share portfolio investing up here on the right. So the risks are, the biggest one would be concentration. And what I mean by that is that all of your wealth or money is tied up in one particular asset. So in this case, you might have all of your funds tied up in one property. Do you have that same risk if you invest in a share portfolio? No, you don't. You have all your wealth spread across various assets. So you own companies like Spark, like Apple, like Samsung, like Infratel. You own a variety of companies. So if one of those companies goes belly up, the rest of your money, which should make up a small percentage of your portfolio, so the rest of your funds are fine. Whereas if you have all of your money invested in property, there's an issue, especially if something goes wrong with the property, the market, all sorts. But we'll get into that as we move through the risks. So another potential risk is volatility. So volatility is the market movement, the performance of property and shares, what returns they deliver over a specific period. So both property and shares experience volatility. You'll probably find that shares get a much higher degree of reporting around it versus residential property though. So what is the risk? Well, the risk is that if you have, again, all your wealth concentrated in one asset, and you need to get that money out, and the market has slumped, then potentially you could lose some money, or you're going to have to give away some returns. So both of these, investing in a share market and property, have those risks attributed to them. So another risk, liability risk. So what I mean by this is, what's your liability by taking on this investment? Well, as a property owner, there's all sorts of liability that comes with owning a property. I was talking to a barrister last week and his role was to sue landlords. And he was currently working through suing a landlord. It wasn't his fault. His tenants manufactured P in his property. The property was on sold to new owners who discovered later that P had been manufactured in the property. So he is suing the landlord on behalf of his clients for damages and losses. Do you have that risk associated in a share portfolio investment? No, you don't. So next risk, liquidity. So liquidity is really the easy flow of funds or the access to funds. With property, again, this is a risk that comes with owning property. Property can be very hard to sell. So we talked about before volatility in an up and down market. Well, if you need to sell a property and it's a down market, it can take months to sell. So that can cause you problems if you've got requirements for cash that are urgent. Versus a share portfolio, usually you can liquidate your portfolio within a couple of weeks. So that's, again, big risk for owning a property, not really a risk for owning a diversified share portfolio. Another risk, so loss of income. So with owning a property, you have a mortgage, you need to cover the mortgage with either your own income or rental income. And if rental income is not coming in, you certainly need to have your own income. With owning a property, you can lose the rent, either through tenants moving out, natural disasters, which I haven't focused on yet with owning property. I'm sure if you look for it, you'll find people in Canterbury that were hit by the earthquake, had damages to their property and lost their rental income for long periods of time. Now, you still have to pay the mortgage in that period. Banks aren't going to let you off that. So you need to find the money somewhere else. And if you can't find it in your own income, then you've got issues. You're going to have to sell the property to pay back the mortgage. And again, if it's damaged, that is going to make it harder to sell. And if all your wealth is tied up in that asset, well, you might not be getting much of your wealth back out of that asset. So these are all risks attributable to property investment. Not all of them are attributable to a diversified share portfolio. Investing in one share brings you concentration risk. But again, it doesn't bring you any of these other risks. And if you lose your income, having your funds in a share portfolio, as I mentioned before, it's very liquid. You can pull that out easily to live off those funds while you look for another job. So which brings me, I guess, to a question I have. Why do New Zealanders own 4 times as much, or have 4 times as much of their wealth tied up in property versus shares and other assets? I mean, that's a question I think I'd like to put out there and maybe get some feedback. But my view is that, we had the 87 share market crash, we had the GFC, and around those times there was a lot of reporting. People talked about losing their wealth. And I'm not sure those situations, but a lot of that might have been concentration of wealth in a particular share or in a particular market, and pulling their money out when the market was down. I mean, when share markets or property markets dip, if you don't need your money out, hang on, because you will get the returns come in the long term. I think it's mainly to do with the reporting. There's a lot of reporting around shares on a daily basis. Market crashes comes out if there's a drop in the share market, whereas there's not so much reporting around property. I think the other thing is people can see and touch property, so they're familiar with it. When people think about shares, I think they don't think about the underlying assets. You actually are an owner of an asset. You will own a share of Spark or Samsung or Apple or some other major company. You will be an owner of that company. So there is a physical asset behind your share. It's just that it's hidden behind a lot of paperwork and reporting. So, as I mentioned, I guess in summary, with property, especially leveraged with a mortgage, you can get some great returns. And the larger your mortgage, the greater your returns will be. But again, the larger your mortgage, the greater your risks will be, especially with volatility. If you purchase a property at $1 million and you borrow 90%, so you put in 100,000, you've got a mortgage of 900,000, that property drops in 10% in value. There goes all of your cash, especially if you need to sell it. So you can get higher returns leveraging a property versus a diversified share portfolio, but there are much greater risks with leveraging an investment property. I hope you found this video helpful, and certainly if you've got any questions or want to talk about anything further, don't hesitate to give me a call. I think there's no right or wrong answer to property versus shares. It just depends on your attitude towards risk, how much effort you want to put into your portfolio, and what you care about, really, because that can be important in terms of what you invest in as well. So thanks again, and talk soon.